Hi, I'm Mike Turner. I've developed a set of rules that I call my 10 essential rules for beating the market. Rule number 9 is the asset allocation rule that tells you how much money that you need to put against each position in your portfolio. Asset allocation in my world is all about how you're spending the money that you've got, your investable dollars, in investing in the stock market. And when I talk to investors, it's an amazing thing to me that I find many investors really don't know how many stocks that they should have in their portfolio. They don't know whether they should have 5 or 10 or 20 or 30 or 50. And as such, when they start buying stocks, they'll just say, well, I'm going to buy this one because I've got the money and I'm going to buy it. They don't have any basis for how they're spending that money. And again, that's going to hurt that investor from a risk perspective. And let me explain to you what I mean by that. If you put more money into one stock than you do another, you have made the decision that you believe that one stock that you're going to put money into is on a risk-adjusted basis, is no more risky dollar for the amount you've invested to the stock that you put less money in. And let me make sure that you understand what I'm talking about. Let's just say you've got stock A and you're going to invest $10,000 in stock A. And in stock B, you really like it, and so you're going to invest $20,000 in it. Now, let's just say that both stocks are in the same sector, same industry. And the industry starts moving up, and then it tanks, and you lose, and that all of a sudden that sector goes down quicker than you can catch it, falls right below through your stop loss. And you lose 5% of your money, 10% of your money in both stocks. But you lost 10% of twice as much money in that second stock than you did the first one. That means you had twice as much risk on the table. And when you're investing in the stock market, you want your risk evenly divided across all of your positions. And this is an easy formula. First thing you want to do is to decide how many stocks that you can have in your portfolio. This is a decision you have to make. Generally, I think that ought to be more than 10, probably less than 20 for most folks. It has a lot to do with how much time you can devote on a weekly basis to your portfolio. A good rule of thumb is an hour or so a week per position. So if you can only devote 10 hours a week to your portfolio, you should probably stick to about 10. If you can devote 20, you probably should think about being able to spend maybe 20 or have 20 positions in your portfolio. But once you have decided how many positions you've got, then the next step is very easy. You simply take the total investable dollars that you've got, and I'm talking about those dollars that you want to have in the stock market, and divide that by the number of positions you have in your portfolio. And never put more money in one position than you do another. I had a gentleman come up to my booth one time at a trade show I was at, and I had just given this talk about this particular rule. He walked up to me and he said, Mike, I think you're all wrong about that. You're just completely wrong. You shouldn't go that. You shouldn't put the same amount of money in each position. And I said, okay, what's your thinking about that? And he said, well, the reason why that your strategy is wrong is that you should put more money in those positions that are making you more money. That's where you should put more money. And I said, okay, why do you own the stocks that aren't making you more money? He didn't like that response. But that is indeed the case. If you've got stocks in your portfolio that are not making you money, get out of them. Sell them. Replace them with stocks that do, but don't violate your rule for asset allocation. Keep the same amount of money in each position.